In 1939, with Hitler's army marching across Europe and every headline screaming panic, a young investor borrowed money to buy 100 shares of every stock trading under $1 on the New York Exchange. 104 companies. 34 of them were already bankrupt. 4 years later, he had nearly quadrupled his money. His name was John Templeton. And he did the one thing the crowd could not do. Here's the uncomfortable truth. The market doesn't reward the smartest people. It rewards the ones who can stand alone when standing alone feels insane. Today you'll learn why the crowd is almost always wrong at the extremes, and the 3 habits that let legendary investors think for themselves. The third one is the hardest, and it's the reason most people never get rich in stocks. Start with a number that should make you uncomfortable. Between 1993 and 2023, the S&P 500 returned about 9.8% a year. The average stock fund investor? Just around 6.3%. That gap isn't fees. It isn't bad luck. It's behavior. People buy when the crowd is euphoric and sell when the crowd is terrified. Think about March 2020. The S&P fell to 2,237 points. The headlines said the world was ending. And the crowd sold, right at the bottom. Anyone who simply held or bought recovered everything in about 5 months. The crowd didn't lose because they were dumb. They lost because they felt exactly what everyone around them felt. Graham said it best. In the short run, the market is a voting machine. In the long run, it's a weighing machine. So if the crowd panics at the exact wrong moment, what does an independent thinker do instead? That's where it gets interesting. In 1963, American Express nearly collapsed over something absurd: salad oil. A company American Express had vouched for turned out to be storing seawater in tanks labeled as vegetable oil. The fraud cost around $150 million. American Express stock got cut in half. Wall Street was sure the company was finished. But a 33-year-old Warren Buffett did something strange. He didn't read the headlines. He walked into restaurants and stood by the cash register. He watched ordinary people keep paying with their American Express cards, night after night. The scandal was loud. But the actual business, the thing that made money, was untouched. So he put around $13 million, a huge chunk of his partnership, into the stock everyone else was dumping. Within a few years, the stock roughly tripled. Here's the question I want you to sit with. Which camp are you in? Do you buy when the headlines scream danger, or do you wait for the crowd to say it's safe? Tell me below, because your honest answer predicts your returns. Buffett wasn't braver than everyone else. He just did his own homework and trusted it. And that leads to the habit almost nobody has. Here's what nobody tells you. By the time an investment feels comfortable, the profit is already gone. Remember what I said at the start, the third habit is the one most people get backwards? This is it. Most investors want confirmation. They want the news to be good, the chart to be green, the crowd to agree. But price and value move in opposite directions from comfort. When a stock is beloved and every headline is glowing, you're paying a premium for that comfort. When it's hated and ignored, that's when value hides. Look at the dot-com peak in March 2000. The Nasdaq was the most loved index on Earth. It then fell about 78% over the next 2 years. The most comfortable investment of that decade became the most painful. Buffett put it plainly. Be fearful when others are greedy, and greedy when others are fearful. Independent thinking isn't about being contrarian for its own sake. That's just following the crowd in reverse. It's about doing the work, forming your own value, and then ignoring the noise entirely. But independence has one dangerous edge, and if you miss it, it can wreck you. Thinking alone is powerful. Thinking alone while wrong is a disaster. The guardrail is your circle of competence. Buffett only bet against the crowd on businesses he deeply understood: consumer brands, insurance, banks. He famously skipped the entire tech boom of the 90s because he admitted he couldn't value it. So independence isn't a license to gamble on things you don't understand. It's permission to trust your own analysis when you've actually done the analysis. And remember, this is educational content, not financial advice. Always do your own research, because the whole point is that the thinking has to be yours. Get that combination right: real homework plus the courage to stand alone, and the crowd's panic becomes your opportunity. Remember what I promised at the start, the habit that lets you buy when everyone else is running? Here it is, distilled. The crowd will always be loudest at the exact moment it's most wrong. Your job isn't to be smarter than everyone. It's to be quieter, to do the work, know your value, and let the noise pass through you. Because in the end, independence of thought isn't a personality trait. It's a discipline. And discipline is the one edge the crowd can never copy. So here's my question: has the crowd ever talked you out of a decision you knew was right? Yes or no? Tell me in the comments. Tomorrow we look at the one number Buffett checks before he trusts any company's earnings, and why it fools almost everyone.